estate, whether it's art, whether it's NFTs, blockchain is not going away. So the question is, how do we take advantage of this?
Another point you've made, and this is, I think, particularly relevant 10 years into a bull market, is that I think you said more money has been lost anticipating a downturn than actually in the downturn. Can you explain?
Well, obviously, the market's gone up tenfold since I stopped running Magellan. So you make more money on the upside. The market's going to be a lot higher in 10 years from now, 20 years from now, 30 years from now. Trying to predict the market is really a waste. I don't know what it's going to do. It can go down. When I ran Magellan, 13 years, it declined 10% or more, 9 times the market.
Wow.
I had a perfect record. I went down more than 10% every time. Wherever the market went down, I went down more. But over the long term, the upside is more than the downside. So you're going to say to yourself, do I need the money in the next month? Do I need the money in the next year? Do I have kids going to college? Do I have a wedding coming up? Then you're a bad investor. If you can keep putting money in, you have 5, 10, 15, 20, 25 year, you should do well.
If you enjoyed this content, be sure to give our video a thumbs up. To keep getting bullion-related news and industry insights, be sure to subscribe to our channel.
Warning, the largest wealth transfer just started. Now, a lot's happened over the last 2 years. We went from the whole world shutting down to new all-time highs in almost every asset and price, and now it's all changing again. Now, over the last year, we've seen the Great Resignation, where a number of workers who quit their jobs broke all-time records. We've seen the World Economic Forum call for the Great Reset, which claims that by 2030, you'll own nothing and be happy. And now we have the Great Wealth Transfer, where millennials are set to inherit $35 trillion. But now we have something even bigger, something that could become the greatest wealth transfer we've ever seen. Now, during a time where the markets are stumbling and crashing, the NASDAQ, it's plunged into bear market territory. We have hundreds of stocks that are trading at their all-time lows, and the economy has finally begun to shrink. Inflation is the highest it's been in 40 years, and a recession is likely on the horizon. Now, although what most people don't know is that beneath all the bad news lies one of the best opportunities to build your wealth quicker than any other recent time. So, in this video, I'm going to break all of this down. I'm going to back it up with charts, data, history, so you can see firsthand just how important these next few months are going to be right after you transfer a like to this video to help me with the YouTube algorithm, because it does make a huge difference. And while you're at it, hit that subscribe button so you don't miss out on any more of these important video updates, okay? I appreciate that. All right, so let's go. All right, welcome back. If you're new to the show, my name is Mark Moss, and I make these videos to change the way you think about money, because almost everything you've learned is wrong, and everything's super confusing. It's confusing by intention. It's purposely confusing so you don't understand what's going on. Now, I'm going to break all this down for you. I'm going to show you the chart so you can understand it very simply. And I'm also going to tell you some things that you should be doing. Now, if you want to know really what I'm doing, specifically what I'm selling and what I'm buying in light of what's just happened with the markets and the Fed in just the last couple of days, I am having about a 1-hour live presentation, not on YouTube. There's a link down below if you want to join. It's free. You can come in. I'm going to show you what I'm selling, what I'm buying, and we're going to do live Q&A at the end. You can check it out for free. Come hang out. There's a link down below. But let's go ahead and just jump into what we're talking about here. Now, to set this all up, talking about wealth transfers is a phenomenon. It's a phenomenon that I have personally studied for over a dozen years. Now, why? Why have I personally studied it? Well, super high level, quick, you probably know my story if you watch these videos, is I was pretty good at making money. I started buying distressed properties from the bank when I was 18 years old, fixing them up, flipping them, started a couple businesses, Fortune 500 exits, everything was going great. 2008 came, boom. I got leveled because I didn't understand what this whole financial casino, what was going on with the Federal Reserve, with the banking system. I didn't understand that part. And no matter how much I knew about business and how to make money, without understanding the financial markets, it was devastating for me. Now, I was able to rebuild things, so don't cry for me too long. But what happened is, as I was starting to figure this out, as I was devastated, I vowed to myself to never let this happen again. I knew that there was a piece of my education that was missing, and so I dug deep into research to figure it out, and I learned this core concept. This core concept has led me to where I'm at today, 12 years of research into this. So what is this? This is that money is like energy. It doesn't disappear. It only transfers. So when I lost my wealth, it transferred to somebody else. Somebody else got my wealth. Somebody else got rich at my expense. Now, I'm not the most competitive person in the world, but I didn't like that. I vowed to never let that happen again. And more importantly, I vowed to learn about these wealth transfer cycles so I could be on the receiving end and not on the giving end. Does that sound good? So let me teach you about that, a little bit of the stuff I've learned. All right, now, the first thing is that these wealth transfer events happen in a few different ways. So they can happen in times when the market crashes. Those create a lot of opportunity. Well, mostly destruction for most people, opportunity for some. We see this with cycles as booms and bust cycles and technological revolutions. So let's take a look at this for real quick to set this up. So understanding the boom and bust cycles. One, why do we have boom and bust cycles? The bust cycle of 2008 got me wiped out. I've been able to benefit back from the boom cycle. But what happened that I didn't know? Well, the answer can be found in the way central banks handle the money supply. Now, this is just Investopedia. This isn't some like crazy fringe conspiracy website. This is just Investopedia. Why do we have boom and bust? Oh, the answer is found in the way central banks handle the money supply. Interesting. Okay. During a boom, central bank makes it easier to obtain credit by lending money at low interest rates. Sound familiar? And individuals and businesses can then borrow money easily and cheaply and invest it in, say, technology stocks. We're going to come back to that in a minute. And houses, tech stocks and houses. Imagine that. We're going to look at both of those. Things that have been overinvested in will decline in value. Investors will lose money. Consumers will cut spending and companies cut jobs because credit becomes more difficult to obtain. And the boom time borrowers become unable to make their loan payments, and then it's a bust. Those people can't afford it. They sell it dirt cheap. People like me step in, buy it up. We'll talk more about that in a minute. Now, there's a difference between a recession and a depression. All right, so a recession lasts for a couple of months. They're short. We're going to look at these cycles so you can know how to play them. And then a depression lasts for years. Now, there's been 34 recessions in the U.S. since 1854. A depression has only occurred once in U.S. history. At least that's what they say. Of course, that's the Great Depression. You probably heard about that one before. A recession is signaled by a drop in employment, retail sales, manufacturing, and income, so everything goes down. A depression's effects on the economy can last for decades, where it takes decades to come back from that. We'll look at that. Now, real quickly, to illustrate how money moves from one person to the next, is we can look at this. This is this gray area right here. This is the tech stock bubble. And recovering from that, we went into what's called the housing bubble. So here we have 2002, 3, 4, 5, 6, 7, 8. This gray area here is the great financial crash. So what happened is, as the housing bubble is going up, homes are appreciating, they're being worth more and more and more, and people want to buy, people want to buy, people want to buy. Everyone's getting rich. People are lined up to buy tract homes. More people are buying, more people are buying. The price just continues going higher and higher and higher. At the end, it attracts the most people. Now, markets stop going up when there's no more buyers. Markets also stop going down when there's no more sellers. But the market stopped going up, there was no more buyers, and then what happened? All of these people that bought right here got wiped out as the market crashed. So they all bought here at the top, and then they were forced to sell, losing all their money. Millions of Americans lost all their money, lost their houses. Then, I was one of them. Then right here, you have Wall Street come along, the rich people come along, and they buy it all for pennies on the dollar, and then the value goes all the way back up higher than it was before. These people lost their money, and it transferred to these people right there. Does that make sense? So which one would you rather be? Would you rather be one of these that gave it up or one of these that received it? Obviously, the answer is pretty clear. All right, now we have these bull runs, so these long-term cycles. Now we have been witnessing the longest bull run in history. It's been going for about 13 and a half years, and the market has gone up by about 630%. We can see that illustrated right here. Now, previous to that, the second longest run was from 1990 to the year 2000, which was 10 years and 430%. And right now, we've been witnessing what we call the everything bubble. So here you can see this. So here's the 2008 crash right here. And since we've come up, you can see this blue trend line. The red line is the 200 moving day average. So you can see it stayed above the 200 moving day average, above the blue line. Now it's dipped below here, and it dipped below here, and it hasn't quite dipped below here yet. And I'm going to break these down for you in a second, all right? So I'm just setting that up for you so you can understand that. Now, remember, booms and busts are driven by the Federal Reserve's money supply, right? So when the Fed changes direction, you should be paying attention, because when they put money in, things go good. When they suck money out, what happens? Hint, it's the opposite of good. So we have inflation. We've seen this. Inflation, record high levels. So the Fed decides to raise rates. First, it was like, oh, inflation's not a big deal. First, it was we can't get the 2% we want. Then it was like, okay, it's more than we want, but don't worry about it. Then it was like, oh, it's transitory, it's going to go away. To then it was like, oh, shoot, we have a problem. To like, oh, holy heck, we better start doing something drastically, raising rates. And even now this week, something that's only been tried one time in history, and that's called quantitative tightening, or QT as it's known. It's been done one time before in history, and spoiler alert, it ended horrifically. How will it turn out this time? Well, let's see. So it looks like we have a recession coming on the horizon. Now, everything right now appears to be selling off, in already acting as if this QT has already been going on, even though it just started. Everything's selling off. We have indexes. The indexes. So we're talking about the S&P 500, the NASDAQ, of course. We can see here, here's the S&P 500 has sold off. Here's the NASDAQ. We can see this decline right here, down 23%. Now, that's just them. Now, remember we talked about, in these booms and busts, we talked about they put money into tech stocks and houses. So here's the tech stocks. Here we have Nvidia, 50%, Facebook, 50%. Some of these, like Square, 71%. We have some really big ones. 75%, Netflix 75%, PayPal 75%, Twilio 76%, Shopify 80%, Teladoc 83%, Roku 83%. I mean, it's just a bloodbath, as you can see. Tech stocks going down. We can also see, I'm going to throw this one out there. Of course, one of my favorite assets, Bitcoin, that I talk about all the time. Year to date, well, these are all down 50, 60, 70, 80%. Bitcoin's also down. We're at about 32%. So, 32%, it's not necessarily the safe haven asset, but it's certainly not down 70, 80% like most of these tech stocks. Now, the crypto market overall is selling off like a tech stock. So here's the total cryptocurrency market caps. This is all of them together, and we can see that it is down. As a matter of fact, year to date, it's down about 40%. Now, I like to say Bitcoin, not crypto. We want to look at that completely separately. And the reason why is because if we look at the total market cap, we're down 40%. If we look at the cryptocurrency market cap without Bitcoin, we are down over 62%. And the reason why is because Bitcoin makes up about half, about a little less than half of the total market. So if we take that out, we're down about over 60%. And most of these big names in the top 10, top 20 are down 70, 80%. And of course, it's not just that. Remember, what do people put money into? Tech stocks and houses. Well, housing, 1 in 5 sellers are dropping their price. Per Redfin, which gets all the data information from the United States, we saw it's down about, 19.1% of all the homes listed on Redfin have been lowered. It's pretty fast. It's pretty drastic. And of course, it's not just all of those assets. The U.S. economy also shrank 1.5%. Remember, there's a recession, and that's when things start slowing. But what happens when they start going negative and it's actually shrinking? Not just the rate of growth changing, but actually going backwards. Now, this is bad. This is scary, especially if you don't know what you're doing. However, it can be our opportunity. Now, I like to think of it like this, like I'm a surfer. I live on the beach. All our vacations are surf trips. I have a wave runner, so I go chase big waves. I love big waves. I'll travel to go big waves. And so let's say that you're in an island in the South Pacific and you get this like storm warning. There's massive surf coming. Well, people are canceling their vacations. I'm not going there. People are leaving that island. But then people like me would be booking trips to go there. So there's massive waves coming, massive volatility. Most people are running in danger, but some people want to go and play. And that's kind of what we can have if we know what we're looking at and if we do it the right way. So in times of volatility, when things go up and down, that creates opportunity. If things always stayed flat, If you bought something for $10 and it was worth $10, what type of investment is that? It doesn't go up. Volatility works both ways. So we're looking for something that goes like this, that we can make money on the way up. Now, I've learned a long time ago, I had to learn this the hard way in 2008, that there's no such thing as good and bad timing. There's good and bad strategies. So what does that mean? That means as long as you can change your strategy, there's always the right time to do something. Now, when money is moving, that presents opportunities in different areas. And this is the key. Money rotates from one sector to the next. More on that in a minute. I'm going to show you exactly what I'm talking about. And this, the volatility, changing the strategies, understand how the money's moving, leads to the wealth transfers that you and I can benefit if we get it right. And I'm going to show you exactly what I mean in a second. From a video I did a few months ago. All right, now, so what we have, and I'm going to frame this up for you, is we have these secular and cyclical markets. So you have to understand what type of a market are we in. Are we in secular or are we in cyclical markets? Let me break that down for you. All right, so first let's look at secular markets real quick. You can kind of see it on this chart, but basically secular markets are long-term movements where they go one direction for a long time. This could typically be 5 years to 20 years, like the bull run that we're in. All right, so we have that. These are long-term periods where it's moving one direction. Then it goes sideways and we have long-term direction here. Now, if we look at some charts, we can see this here. So here's a long-term secular market of the S&P 500. So again, we looked at this one before. Here's 2008. And since then, it's been in this long-term secular bull market. That's what we call that. All right. And you can see how it's maintained that trend. Now, even though the trend has been going up, you can see that there's a dip here, there's a dip here, there's a big dip here, big dip here, big dip, right? But the trend has continued up. Now, if we look at this, if we dig in, we can see that back here in 2008, when this happened, from the peak here to the peak over here was 300 bars of 52 weeks. So it's about 6 years the market took to go from peak to peak. Remember, long-term, 5 or 10 years. So we had this long-term trend where it went down. In times like this, it's best to just sell, get out, and go away. Now, your financial advisor will tell you it's not timing the market, it's staying in the market, it's time in the market. And if you would have just bought here and you would have held for here, you'd always get out ahead. Well, that's true, but do you have this long? Let's say that you're retiring right around here. Do you have that time period to hopefully make that money back? Wouldn't it have been better just to sell out somewhere around here or here and buy back in somewhere around here or here? All right, so let's break that down a little bit. You would want to exit and you'd want to come back. Now, cyclical markets are a little bit different. Cyclical markets happen within the long-term secular market, and they typically happen in a few months to a few years. And so we can see that illustrated in this chart. So here's back this 2008 crash, about 6 years from peak to peak. But then we started this long secular market, but then we have these cyclical downturns right here and here. Now, this requires a different strategy. So in this time of the market, a strategy would be to sell, go away, come back later. Remember my surfing analogy? We don't try to create waves. What we do is we study the storms. We see where those storms are going to send the waves, and then we just go there and we ride those waves when they get there. So we're trying to ride the wave or ride the trend, if you will. If the trend's down, we're going to ride it down or we're going to get out. And then when the trend's up, we'll ride it back up. Now, when it's cyclical within a long-term secular, these are what we call buy the dip moments. All right, buy the dip moments. I'm going to break that down for you a little bit and show you what that looks like. Now, a couple things to look at. In this last cyclical downturn, in this long-term secular market, so here we have 2018-19 when Jerome Powell came in fired up and he was going to bring markets back and he was going to do quantitative tightening. Remember I said it happened one time in history? Well, this is the effect of it happening. And as you can see, the markets crashed. They didn't like the quantitative tightening because, of course, you can't taper a Ponzi. But here we were, so we're in this long-term secular trend, but then we had this big dip. So the market dipped about 20% and then it came back. Which happened in about 2.8 years. So about 2.5 years it took to recover that time period. Now, That's good. So if you could have bought at the bottom and you could have rode it back up, you would have made 20%. Okay, great. However, what I call world dominator stocks, companies that own the categories, own the markets, the companies that are going to be there for 25, 50 years from now, did much better. Apple did over 400% return. If you would have bought it in the dip, instead of making 20%, you would have made 400%. Microsoft, 250% almost. Google, almost 200% returns on world dominators. So while the average market did 20%, world dominators did 200%, 300%, 400%. That's the difference, and that's why you have to understand there's different timing and different strategies for these things. The other thing that you have to understand is, as I said, this market, the way that it rotates. So we've been with risk on, meaning tech. All the money goes into tech. We've talked about that. We also talked about how bad these tech stocks have been imploding. However, at the beginning of the year, I made a video telling you what was going to happen. It's right here, market rotation. And I want to play you a little clip from this video right here. When they've gone from stimulating the market and having inflation or prices, asset prices, consumer prices going up, now they're sucking money out, then we'll start to see deflation. What happens is money starts going to different places. You need to understand there's different ways to invest. I like to call it my 4-pillar blueprint. There's 4 quadrants to the market, and depending on what's happening with inflation or economic growth, then you want to invest into one of these 4 quadrants. And so when we have inflation that they're going to try to tackle to come down, the economy slowing down, we want to rotate our investments to another sector of the market, which is what we're seeing, a market rotation. All right, so at the beginning of the year, I told you what was going to happen. The money was moving from one sector to the next. That means it's time to get out of here and come over here, as Wayne Gretzky would say, skating to where the puck was going to be, or rather moving to where the money is going to go. And so it's played out pretty much like I forecast at the beginning of the year. And so all the tech stocks are down. If you held on to these, some of these names, you're down 50, 60, 80% on some of these. Coinbase is down 90%. Are you kidding me? Like I said, Teladoc down 83%. Wix websites 80%, Shopify 80%. So if you would have stuck in those, you would have done really well. However, if you would have watched that video and you would have moved on that, then you would see here's a commodity basket. And if you would have bought it at that time right here, you could see that instead of being down 80 or 90%, you're actually up 40%. So while everyone's losing money here, you're making money over here. You're up 40% on that. I also talked about energy in that video. This is just a basic way to play uranium, which is an energy play. There's lots of energy plays that have done better, and I have those in my private group. I'm not going to break them down here. But we can see here this uranium play. We're up about 10% in that time frame. It's not huge. It's up 10%, but it's better than being down 80%, isn't it? And even gold, which again is in the commodity basket, precious metals, we buy it mostly as a protection against volatility. It's a safe haven asset. So in that same time period, gold is only up by less than 1%. However, it's up. It's not down 70, 80, 90%, or even 30% like Bitcoin. It is basically flat. And so we want to use these times to change our strategy and move to the sectors where the money is moving. Now, another big phenomenon, this is the biggest phenomenon. So there's lots of different wealth transfer phenomenons. The biggest wealth transfer phenomenon there is a technological revolution. They happen on about a 50 to 60 year time frame. There's been 5 of them in the last 250 years. And it's easy to see we have steel, we have oil, we have telecom computers, and now, of course, my favorite, Bitcoin. Each one of these have driven markets. What's driven the markets over the last 40, 50 years? Telecom, internet, right? What drove it before that? That was Ford, GM, automobiles. What happened? What drove it before that? Oil, steel, etc. And so when you can find these new technological revolutions, you can move into them early, and then you can let it ride over a long period of time. You can make a crazy amount of money. Now, I'm going to do a whole separate video just on this alone, probably the next week or two, so stay tuned on the channel. If you're not already subscribed to the channel, take a second, click on that subscribe button right now. Of course, hit the like button if you're liking what I'm talking about. Now, all right, so the great transfer, the greatest wealth transfer, I believe it's the greatest wealth transfer that not only will I ever see in my lifetime, I think it's probably the greatest wealth transfer that We'll see in multiple generations. It's literally that big because we're witnessing the end of the longest bull run in history. We're also witnessing a technological revolution happening at the same time. So a couple things to remember. One, volatility is your friend. Just like those big waves, most people are leaving, they're fleeing. I'm going there. Volatility is scary if you don't know what you're looking at, if you're not prepared. If you do, it's your friend. You need volatility because you can't make money in a straight line. You need it going like this to make money. The next thing, make a list of the buys that you want. Remember, the tech stocks got crushed and the market in 2018-19, it rebounded 20%, but the world dominator stocks went up 2, 3, 400%. So use these dips to make a list of the buys that you want, the world dominator companies that you want to own, and when they're on sale, you buy those. Not speculative companies. It's not time to go out and buy this XYZ cryptocurrency, but these world dominator stocks are that. The next thing is wait for the trends to happen. Now, we just started quantitative tightening. It's happened one time in history before. The results were catastrophic. What could happen this time? Could it continue going down? Will the Fed pivot? Will they go back up? I know you're like, Mark, you just made a video and you said the Fed maybe has one more rate hike in them before they pivot. I did make that video, and you're right, but we don't know exactly how bad the damage will be, how quickly they can pivot, if they even do at all, and can they recover from that. We don't know. And so instead of trying to catch falling knives, you don't want to do that because you cut your fingers off. Remember, like a surfer, we watch the storm, we wait for the waves to show up, and we ride them. So we want to wait for the trend to develop, and then we'll ride that trend. And the other thing is we want to have a long-term perspective. So when we're talking about these great wealth transfers, they don't happen in days, weeks, or months. They happen in years. The greatest ones happen in decades. So you want to have the long-term perspective. One of the best or most famous investors in history, Warren Buffett, says that the stock market is a device. The stock market's a device for transferring money from the inpatient to the patient. I'm patient. What are you? Leave me a comment down below. Patient or inpatient? Let me know what you think. Of course, as always, give me a thumbs up to this video if you like it. If you don't, you can give me a thumbs down. That's okay. Make sure to hit the subscribe button and tell me if you're patient or impatient. And if you want to know exactly what I'm selling and what I'm buying and how I'm playing this, come hang out with me next week. Go live for about an hour, do question and answer, all of that. There's a link down below if you want to join me. And that's what I got for you today, all right? To your success. I'm out.
You want to know how to be a successful investor? The answer is stay with what you know. Don't listen to me. Don't listen to TV people, internet people. Just stay with what you know. If I told you you can only have 20 investments in your life, you would be very careful. You wouldn't be jumping in and out, listening to hot tips every day, every month. You would stay with what you know and you would become a successful investor. Everybody watching this knows a lot about something, whether it's fashion or cars or sports or something. When you see something that you know is going to be successful and exciting, don't just say, oh, that's going to be great. Don't tell all you. Then you go and you do your research and you figure out how to and if you should invest and how to invest, and then you invest. You will know it long before I will, or long before other people in the investment community. You will also know when to sell, because you will know when something's going to change again. Nobody likes to hear it. Everybody wants a hot tip. Everybody wants to be rich this month. In those days, we did nothing but focus and concentrate and dig deep and dig deep and dig deep.
Hi there, Greg.